Traders, wherever you are in the world, I hope you're doing well, I hope you're safe, I hope you're healthy, I hope you've got a big smile on your face, and I hope you're catching pips as usual. Pips of Persia here with another full video breakdown of a fantastic risk to reward trade that was taken last week. So in this video we are going to be covering Wyckoff Distribution, market structure and what makes a distribution valid, higher time frame bias and lower time frame consistency, in essence a full top-down analysis, and minimal risk positions, how to be able to use fractals and lower time frames and patience for that matter in your favor for you to be able to take much better risk to reward positions. Now, disclaimers as usual before we get into it. Anything in this video or in this channel for that matter is only for educational purposes and by no means require any action. These markets are risky. You have to know how to manage your risk properly, so never ever risk more than what you're willing to lose, okay? These videos are specifically and only for educational purposes. You have to do your own research and any positions that you take is at your own risk. So let's go ahead and jump straight into it. This specific trade for Canadian dollar versus Japanese yen, which technically speaking now is floating at well over a 1-to-100 risk to reward ratio, but I'm not going to take credit for the full 1-to-100. My positions were closed at around the 1-to-58, which is fantastic. This was a trade that was taken last week, kept open over the weekend. Let's go ahead and jump straight into breaking this down. Now, as of right now, I'm going to switch to the forex.com data feed on TradingView just so I can describe what was seen last week. Currently, it's Thursday, 17th of September 2020 at 10 to 3 p.m. UK time. So, let's put this in replay mode. To this candle, this final candle now is 8th of September 2020. So, what was seen last week for CADJPY on the daily time frame was this institutional buy before you sell. This candle, this buy before you sell, or this institutional candle is more or less what gave it away on the higher time frame that potentially we will be looking at some sell positions, this week, which was a trade that we took, right? Now, some of you might find it difficult to exactly identify this as a buy before you sell or as an institutional candle, because you might think to yourself, hang on a second, this didn't necessarily go above all of these wicks to grab liquidity. It didn't necessarily hit people's stop losses, so how comes that's an institutional candle? Let me describe it like this. If I go ahead and block off all of these candles before that, all of a sudden that candle over there looks a lot nicer as a buy before you sell candle, as an institutional candle, because it looks like it's a candle at the top of the range. So just because a few previous candles might have not been manipulated, that doesn't make an institutional candle invalid. The way I at least look at institutional candles is what candle has caused the market to have a very strong move straight after. This is very clear that the market was pushed up, positions were opened to push the market higher, to give the institutions perhaps a better entry points, discounted entry points rather, for those sell positions, or better entry points for those sell positions, to then push the market down. And the fact that the market reversed so quickly and impulsively after, it also gave it away that that's most likely an institutional candle in play. Now, if that is an institutional candle, the area that we'd be looking at is practically that candle itself for entries, right? Let's say the wick to around the 50% of the body. Roughly this area would be the type of area you'd be looking at for these entries. Now, the thing is, I personally would never want to enter based on the daily time frame, because if I am to enter based on that open price of that institutional candle, then my stop losses would practically have to be at this structural high, and that's a 55 pip stop loss. Nothing wrong with a 55 pip stop loss, but it wouldn't give us the risk to reward ratio that we'll be looking at. So what was done last week is we identified the wick of this candle, so literally the low of this candle over here, and furthermore the full imbalance closure was also identified over there. This full imbalance closure over there. Now again, some of you may think, hang on a second, this imbalance hasn't even formed yet. How do you know that there's an imbalance over here? Well, we haven't reached back into this level, and if this market is not meant to leave an imbalance open, chances are it will reach back within. So that's a general area that we were looking at last week. That's that general area that we wanted to potentially be able to take trades based on. based on lower time frames. Now, instead of these two lines, you might have said to yourself, you know what, I'm only going to be identifying the open price of that institutional candle. You could do that as well. So just as an average, I'm just going to put the open price of that institutional candle. So based on the daily time frame and based on what we've seen on the daily time frame, a buy before you sell institutional candle and multiple breaks of structure to the downside, that looks good for a sell position. I don't necessarily need to look at anything else for this specific pair, at least on the daily time frame, for me to know that, okay, you know, I should be expecting some sell positions over there. Now, just because that's an institutional candle doesn't necessarily mean the market will come up, you know, tap off this candle and reverse straight away. That doesn't necessarily have to happen. This is where lower time frame consistency of bias will come in. So the analysis was, once the market approaches the desired levels, we would want to see how we react. Are we going to get distribution? Are we going to, you know, very impulsively go through that level? All of this comes with patience and comes with lower time frame consistency of bias, right? So from here, we would zoom into about the 4-hour or the hourly time frame. And on the hourly time frame, we'd just be waiting, we'd have this patience for the market to reach that desired level, reach this desired open price of that daily candle. So the rest of it is having some patience, letting the market do its thing. And upon approaching this level, just before it tapped off that desired level, we started to receive forms of distribution. It might be a little bit tough to see it on the hourly time frame, but the bottom line is the market, after an impulsive move, started to slow down, started to perhaps maybe form some liquidity above, wanted to grab that liquidity and drop. Okay, so this is where we can zoom into the 15-minute time frame from there to wait and see how did the market indeed react to that level. Now, this was this full distribution that was now formed on the 15-minute time frame. Now, how can I see that this is a distribution, and what in general is a distribution? I can't go, you know, a lot in detail about distribution, otherwise this video will be way too long. But generally speaking, we have spoken this about in previous videos. So if you have not seen the previous videos posted in this channel, go to the channel right now and watch the previous 5 or 6 videos posted for you to get a better understanding of these concepts. But generally speaking, a distribution will be a manipulation of the highs and a breaker structure to the downside. That is what we consider, or that is what I consider a distribution, right? Once we start to manipulate the highs, meaning what? Whoever who was the early sellers in the market, whoever out of the retail traders who were selling this market maybe based on this potential resistance level or whatever else, were manipulated out. And once these manipulations would take place, I would expect a break of structure to the downside. If I want to now go ahead and mark up this distribution, again, from a Wyckoffian standpoint, it is going to look similar to this. This is going to be our preliminary supply up here. That's our preliminary supply. Now, following that preliminary supply, we have our, following that preliminary supply, this is our bias climax. All of this move to the downside could be you know, looked at as a sign of weakness, especially because the market did indeed reach below previous lows. So that's a sign of weakness, the market saying that, hey, I'm ready to drop. Following this could be that UT, your up thrust, and that final UTAD, right? So that's that full distribution now being formed over there from the preliminary supply, bias climax, sign of weakness, UT, and that UTAD over there. Now, before I go any further, some of you may be thinking, hang on a second, how comes this wasn't looked at as a distribution schematic number 2? Where instead of getting that final UTAD, what ends up happening is the market creates a last point of supply over there and dropping. So some of you might have been looking at this scenario where you were thinking, okay, preliminary supply, bias climax, sign of weakness, up thrust, and a break of structure to the downside. Therefore, this could be our last point of supply before this market drops. Now, this could very well be valid, and there's 2 ways I'm going to go ahead and describe this. Number 1, this market did not spend a lot of time on the other side of this structure, right? If that is my last point of structure over there, and a break of that structure would prove to me that this is now turning into a bearish trend, I would need to see the market spend time on the other side of this structure. If it's just going to practically grab liquidity and run back into that level, that's definitely not something that I would want to see. And on the other hand, and most importantly, this is where risk to reward comes in. So even if you were looking at that upthrust over there, thinking to yourself, okay, I'm going to be taking trades based on this buy before you sell institutional candle, because I believe this is going to be our last point of supply. Maybe you had your Fibonacci's in place and you were saying that is around, you know, 786, 886, desired levels for these type of entries, so everything was lining up and you decided to take a trade over there, it's not an issue because that would be one loss, maybe 1% of your account gone, and then later on, once you saw that UTAD form and a proper break of structure, you would have made back that loss, if that makes sense. So never think to yourself, oh, how comes this, how comes that? When you are looking at higher risk to reward ratios, you don't really need to be accurate about 80, 90, 100% of the time. Now, let's play this a little bit so that UTAD gets formed. Now, here's the beautiful part. That UTAD, the final point of that distribution, the final manipulation to the upside, that final wipeout of whoever who was selling this early, got formed where? Exactly at the open price of that daily buy before you sell. So once we approached our desired level on the daily time frame, the lower time frame was confirming that bias. That's what I mean when I say consistency of bias. So on the daily time frame, you have a bearish bias. On the hourly or the 15-minute time frame, what you can see is very clear consistency of that bias. We're literally distributing as the market is approaching our desired levels for those potential sell positions. Now, once this took place, what would we expect? Again, we said the distribution is a manipulation of the highs and a break of structure to the downside. Now, our main structure point on this specific time frame is here. That is that 15-minute structure point. So if/when we break this structure to the downside, that confirms that distribution. So we have patience, we wait. Now this is this break of this structure to the downside. And I want you to look at the difference between this break of structure here and what took place at this level. How much more the market spent time on the other side of this level versus over there. One thing that I always talk about is to know the major difference between a break of structure and a manipulation of a certain structure point. Look at how much time the market has spent on the other time of the on the other side of the zone, right? Because technically speaking, if we are expecting some type of a manipulation of these lows over here, then that definition of manipulation is practically the institutions having to hedge their positions. They are selling to buy it back. So we would expect a relatively quick move. Whereas when it comes to a proper break of structure, there would be no need for these institutions to want to then hedge back their positions. Therefore, the market is more likely to spend a little bit more time on the other side of that level. Hence now this is that fully confirmed break of structure to the downside. So this literally could be your break of structure over here. And once this is formed, then we would expect your last point of supply, or the last point of supply rather, to be formed over there. Now, I will show before and after, by the way. This trade is documented fully. I'll go back to the FXCM data feed a little bit later on. But if you were looking at this on the 15-minute time frame and you thought to yourself, okay, if this is a full distribution, we're meant to be creating this last point of supply now. But where? The only level that's practically left open on the 15-minute time frame is this imbalance up here. Nothing else. You might be thinking, Mehdi, isn't this an institutional buy before you sell? How comes you didn't take trades based on this? There were very good reasons why not to take trades based on that. If I want to go through it very quickly, if that is an institutional buy before you sell, why did this wick reach back within? That's something that's a little bit strange for me, for this wick to come back within that institutional candle and drop. So that kind of gave it away. I thought to myself, that's probably mitigated already, so I don't necessarily need to look at that level anymore. But this 15-minute imbalance is probably the only imbalance that's now left open. And from there, when you looked at that same level on the 5-minute time frame, you were able to see this institutional buy before sell. That's another institutional candle right over there. So identifying the open price of that institutional candle, that lines up perfectly with that 15-minute full imbalance closure. Again, let's look at the 15-minute imbalance. That's our 15-minute imbalance between these two candles, or rather these two wicks, and that's confirmed by that 5-minute buy before you sell candle. Now, if you wanted to take trades based on this, entries again would have been at the open price potentially of this buy before you sell candle, and your stops would have naturally been at the high. So stop losses would have been somewhere around there, which is not a bad trade opportunity at all. This at the end of the day is a sub 10 pip stop loss, if I'm not mistaken. This should be around 9 pips as far as I remember. Yeah, 9 pip stop loss, right? So that's absolutely fine. That's a fantastic stop loss, fantastic, risk to reward as well for you to want to execute based on. But if you did want to execute this, then your trades would have looked like this, and potentially, let's say, take profits back at this low. So amazing, 1 to 10 risk to reward ratio, fantastic opportunity to look at. which is great. You know, this is so easy to take these trades. Now, I'll leave this here and then we'll speak about more fractal nature of the market after. As of right now, we are practically waiting for this market to approach that 15-minute imbalance, that 5-minute buy before you sell, close that imbalance, mitigate off of that institutional candle on the 5-minute. That's that mitigation that took place over there, right? That's that push to the upside that finally took place, right? So that's potentially your last point of supply over there. And if you did enter based on that level, that would have been a fantastic 1 to 10 risk to reward ratio. Amazing. Now, this is where lower time frame consistency of bias would come into play. On the 5-minute time frame, we mitigated that level. This is where 3-minute time frame came into play. On the 3-minute time frame, once that last level, that final zone on the 15-minute time frame was mitigated, we started to form a bearish trend. So the market has mitigated out of whatever it needed to. There's nothing else that needs to be taken care of. And we have got a full distribution over there. There is no need for this market to come back up. There is no need for this market to create a new high. There's no need for this market to even go above that last point of supply for that matter. So this is where we can start to look at lower time frame for better entries. And on the lower time frames, we literally got high, low, lower high, lower low. So, you know, from a structural standpoint, that's the start of that bearish trend over there. Amazing. So, if that is now the start of the bearish trend, here's how I want you to look at it. Since that was our last point of supply and the market dropped, this pullback most likely mitigated everything that needed to be mitigated over there. From imbalances to institutional candles to whatever else that needed to be taken care of. That move took care of that. And hence, from there, the market dropped and again broke the previous structure point to the downside. That's where we started to get that high, low, lower high, lower low. Then that tells us our entries would practically need to be there or below. That is the highest level that we would expect this market to now reach, because practically if it comes up any higher in this specific scenario, other scenarios, other distributions can be very, very different. But in this specific scenario, if it visits a little bit higher, then maybe we are actually mistaken about that potential distribution and we might need to go ahead and reanalyze certain things. Now, this is the picture of before. This was taken on September the 11th at 10 to 11 a.m. UK time. And that's the same 3-minute picture over there, where the entries that was marked up over there was based on the open price of this final buy before you sell candle. The open price of this final buy before you sell candle. And again, that was also complemented by this imbalance that we had straight after that buy before you sell institutional candle, right? So we can now go back here. This was our open price of that institutional candle, which means our stop losses would have to just be at that high over there. We don't need bigger stop losses for this specific trade. So our stops could literally be at this high over there, right? This is where I'm going to now go ahead and switch back to forex.com, sorry, to FXCM. And again, you have to bear with me so I can put this in replay mode again. Right around there. So let's go back to the 3-minute time frame now. So again, that's the before and after. 80.692 was the entry point, with 80.707 being the stop loss. 80.692, 80.707 entries at the open price of that institutional candle. If you actually took entries based on the 50% of that candle, this would have also worked out perfectly for you. The market actually mitigated the 50% of that level, but our markup was based on the open price of the candle. The rest of it is having that patience for the market to reach your desired level, and once it does, pull the trigger. Once it does, enter the trade. Simple as that, right? So we wait, we have patience, and boom. That's that rejection that we got over there, and the market did indeed start to drop straight after that, right? Now, this was, if I'm not mistaken, 1.5 pip stop loss. Yes, 1.5 pips. So before I go any further, this is where spreads come into play. So I have to talk a little bit about spreads here. Depending on the broker that you trade with and depending on the account type that you have on that broker, your spreads will be extremely different to other people trading, right? So if you're on true ECN or raw spread account types, then naturally your spreads are going to be significantly lower than standard accounts, right? So within raw spreads or true ECN accounts, your spreads are as small as they possibly could be. So the spreads for CADJPY, for my specific broker at least, is roughly around 2 to 3 pipettes. So that's absolutely fine within this scenario. The market did have even breathing room for it to go in drawdown a little bit and then drop for us to not be taken out of this trade, if that makes sense, right? And a little nugget that I'll share now, but later on, maybe in other videos, I'll go into a little bit more detail about it. Within buy positions in the market, the spreads can never manipulate you out. It's only the sell positions that the spreads can take you out of your trades. I'm going to repeat that one more time. You can go and do your own research on this and see exactly what I mean by that. But in a buy position in the market, when you're buying a given currency pair, there's no way the spreads can manipulate you out. If you're going to be taken out of that trade, it would have to be the true price of the market reaching your stop loss. Whereas within the sell position, that's not the case. Within a sell position, the spreads can indeed manipulate you out. So within a sell position, you have to always make sure to maybe allow a few extra pipettes or pips for your spreads, depending on your broker and your account type, okay? Now, 1.5 pip stop, and in terms of the take profits for this specific trade, we can go back to the daily time frame. Let me put this above there. So on the daily time frame, this is technically an imbalance that the market needs to close, right? That's that imbalance over there that this market needs to close. So some of you may have had your take profits at the full closure of this imbalance all the way down here, which you would have been looking at a much better risk to reward, 1:86, or maybe even higher for where the market reached towards a 1:100 risk to reward ratio. But as I said, for this specific trade, my personal take profits were just at these lows over here. On the 2-hour time frame, when you look at this structure, we had a very kind of clear sell before you buy candle over there. This orange line is the 50% of this 2-hour sell before you buy, and at the 50% of this 2-hour sell before you buy, that would be a 1:50 risk to reward ratio, where a lot of the positions were taken off the table at that area. And for this specific trade, I took everything off the table at that low, which gave us a 1:58, which is again fantastic risk to reward. Now let's zoom in again to the 15-minute time frame just to kind of see how this generally played out. The rest of it is just being patient, letting the market do its thing. Let me go on a higher time frame actually. Letting the market do its thing, letting the market have this decline, and be patient for this market to actually, visit your desired areas, hit your take profit, and even go lower, which is what we actually saw on Canadian dollar, Japanese yen. As mentioned, this would have been a more than a 1:100 risk reward, not something I'm going to take credit for, and not something at this stage anyone should practically care about really. When you're catching higher risk reward ratios, the rest of it is greed. For me to now think to myself, oh, maybe I should have kept this trade open up until then. Oh, I would have made this much more money and this and that. That's just greed talking. And the reason I'm mentioning this is because I know a lot of people watching this video have probably experienced stuff like this in the past, where you're thinking, oh, if I just kept this trade open, the amount of money that I would have made from it, or oh, if I didn't close this trade early, if I, had a better stop loss or this and that. That's just greed, generally talking to you, okay? So, as you know, psychology is a massive part of this game. So make sure to always be in full control of your emotions, especially when you are having, good risk to reward ratios and consistency. Now, this practically kind of is a full breakdown of this trade scenario right now. Again, that was the screenshot taken before on September the 11th, and that's the outcome of the trade. So what we managed to actually speak about today was, where is this writing gone? There it is. So Wyckoff distribution. We spoke about the distribution schematic number 1 for Wyckoff, where you get that UTAD, that final manipulation to the upside. Let's go ahead and revisit that distribution as well on the 15-minute time frame. That's the distribution that we received for Wyckoff over there. Well, Wyckoff distribution, not distribution for Wyckoff, but that's the Wyckoff distribution that we received over there that we managed to see on the charts. Following that, what was mentioned was market structure. So once we identified that distribution, what was kind of said after, and what we managed to see after rather, was, let me do this in anchored text just to make it a little bit easier. There we go. So once that distribution was identified over there on the 15-minute time frame, what we spoke about after that was that break of structure to the downside, and how the market spent time on the other side of the level without reversing so quickly and going back in that level. You might think to yourself, okay, what is the definition of quick? What is the definition of spending a lot of time on the other side of the level? That comes down to the time frame that you're looking at. But the bottom line is, you don't want to see anything that would show you potentially that was an institutional sell before you buy. Potentially that may be where institutions might be hedging their positions, right? Higher time frame bias plus lower time frame consistency. Again, we looked at that daily institutional buy before you sell. Daily institutional candle, where is it? There it is. Daily buy before you sell, right over there. We identified again the wick of it, or you might have been looking at the open price of that candle over there. That's where the market rejected. Okay, so that was that daily zone, the higher time frame bias, the higher time frame level, and the lower time frame consistency after that. And then with a little bit of patience after that, instead of catching it at the high over there for a 1 to 10 risk to reward ratio with the same take profits, now you would have been able to wait a little bit more, look at the fractal nature of the market, zoom in a little bit more, and be left with a 1 to 58 risk to reward, which is also fantastic. Now, as I said, I was actually going to be covering a couple scenarios on USD/JPY as well, another distribution that was looked at last week, but I will be recording another video on that later on, so stay tuned for that. That is a full breakdown of that CADJPY trade. I hope it made sense to you. I hope it was a video that you managed to get some value from. Let me know your thoughts in the comment section, because I know a few of you managed to actually catch similar trades on CADJPY as well. So let me know what you think. Let me know any improvements that you would want to see based on these breakdowns, or any other areas that you would want me to, break down a little bit more based on these scenarios. I'm looking forward to seeing your comments down below. If you're not subscribed to the channel already, make sure to subscribe so you get notified whenever I post a video. I try to be a little bit more consistent with posting, but life gets in the way sometimes, let's be honest. I hope you managed to gain some value from this video again. Have an amazing rest of your day. Let me know your thoughts down below in the comment section. And let's kill it. Let's catch these pips as usual.